Warm greetings to all the learners of Dr. B.R. Ambedkar Open University. Welcome to this session on commodities market. This is a part of your course on business organization for the program BCom. As we have already seen in one of the previous lessons, which was related to stock exchange, where we are talking about raising capital through issue of shares, where a stock market or a stock exchange like Bombay Stock Exchange or National Stock Exchange is available for investors to invest their money in shares of a company. Similarly, when a person does not want to buy shares of a company, but still want to make investment in certain securities which are backed by certain commodities, then you have a commodity market which is available. Basically, the principle based on which a commodity market operates is called as a derivative, where the value of a security is actually derived from the value of an underlying asset. For example, if we talk about agriculture, then in agriculture we have commodities such as grains, pulses, or we have oil seeds. So, in case we are talking about a security whose value is derived from an oil seed, for example, palm oil seeds, or we talk about cereals like chana dal, urad dal, and then we have all these as agricultural commodities. As an investor, I do not want to buy shares of a company, but I want to invest in a derivative where the value of a security is derived from the value of an underlying asset. So, I am investing in a security whose value is actually coming from the value of agricultural commodity or value of gold or silver or value of energy resources, then such a trade which I am doing in this security is called as a derivative. If you are trading in security like shares, equity of a company, then you have a stock exchange like Bombay Stock Exchange or National Stock Exchange, where you can buy and sell these securities. But if I am trading in securities whose value is derived from the value of underlying asset, then I am trading in a market which is called as a commodities market. So, it is not a stock market like BSE or NSE, but I am trading in another market which is called as a commodity market. This market is also recognized by Securities and Exchange Board of India, like how you have a stock market NSE and BSE, which is recognized by Securities and Exchange Board of India. Similarly, you have commodity market also, which is also recognized by Securities and Exchange Board of India. The only difference is that when you are trading in equity, that is shares, then you are investing in security of NSE or BSE, that is shares are traded there. But if you are investing in a security whose value is derived from the value of another asset like an agricultural commodity or oil or energy resources or bullion like gold and silver, then you are trading in these securities in a market which is called as a commodity market. So, with this understanding, let us now see what is a commodity, what is commodity trading, and what is a commodities market which is there. Coming to trading. Trading basically is nothing but exchange of one item for another item. When you talk it from the perspective of investment, we are talking about buying and selling of goods and services, buying and selling of security. So, when we buy and sell goods and services, we are buying this in exchange for cash, we are buying this in exchange for money or in exchange for capital. We are investing the money in that particular buying and selling which happens. In a stock market, we talk about buying and selling of shares. So, you have equity of a company, company raises their capital by issuing shares in a stock market. When you talk about a commodities market, we are talking about trading in security which is backed by a commodity. These commodities can be of different types which we use in our daily lives. It can be commodity in the form of food, where we derive commodities from agriculture like pulses, wheat, rice, barley, or oil seeds which are there, soya bean, all these are all commodities which are coming from agriculture, that is food which we use in our daily life. Or we can have commodity in the form of metals like gold, aluminium, nickel, copper, zinc, platinum, all these are all metals which are there, and we can trade in a security whose value is derived from the value of a metal. Or we can also trade in precious metals like gold and silver, which is there. So metal can be a base metal or it can be a precious metal, which can be there. Similarly, we can also trade in energy in the form of oil, gasoline, heating gas, etc. All these are also can be traded. These are all everyday commodities which we use in our daily lives, and these commodities can actually be converted into a security. The value of these commodity help us to derive the value of commodities which are traded as a security as such. So in a commodities market, any security whose value is derived from the value of all these commodities is being actually traded. In a commodities market, like how you have in a stock market like NSE and BSE, you have trading of shares which take place. Here in a commodity market, you have trading of commodities. Commodities are basically split into two categories. You have got soft commodity and hard commodity. A hard commodity is something which is actually including natural resources. So it can be something which has to be where you have to take up mining or extraction. For example, gold, or you talk about oil, crude oil, oil resources. All these where mining and extraction has to take place, these are all called as your hard commodities which are there. Similarly, you can also have a second category which is called as a soft commodity, which basically includes agricultural products which are there, where irrigation, you apply the concept of irrigation in order to grow these commodities, and these commodities are not extracted, these commodities are actually grown, which are there by using the technique of agriculture. So you call them as soft commodities which are there. So you have agricultural commodities where you talk about grains or livestock also, which is a part of agricultural commodity, where basic concentration is on food supply. Or you can call our energy commodities, where we are talking about natural resources which are being taken from the soil or from the earth's crust, where you talk about natural gas, crude oil, etc., where you have a lot of price volatility which takes place on account of geopolitics, because these are all based on certain geographical locations. So you have geopolitics which plays an important role there. So you have energy commodities coming into picture. Then you have metals and minerals, where we have precious metals and even the base metals which are there. Gold and silver, platinum are the precious metal. Copper, zinc, aluminium, etc. will be your base metals which are there. So commodity metal serves as a base for you to derive the value of your security. Likewise, you have other commodities which do not fall into agriculture, energy or metals. These are all categorized as other commodities, where you talk about items such as rubber, carbon credits or lumber. All these are all commodities where you have a niche market, a very small market which is available, and this plays a very specific role in the economic development of a country as such. So the commodities which are being traded in these commodity markets, they are basically, we can also call them as sector specific, where we talk about agriculture sector, where we are saying grains, spices, pulses, oil seeds which can come into picture, which get traded. For example, in grains, the security value can be derived from the value of rice or basmati rice, wheat, maize, jowar, because these are all grains which are there. Or we can have oil and oil seeds which get traded. For example, castor oil, soya seeds, castor seeds, soya meal, or we can have palm oil which can be there, mustard seeds, groundnut oil. All these are all can be commodities which again belong to agriculture, but they are not grains, they are oil and oil seeds. Then we can have spices, cardamom, chili, red chili, turmeric, all these become a part of your spices which are also being traded. Then you have pulses like chana, urad, yellow peas, all these are all examples as a part of your agriculture, within which you have the sub-classification of all these commodities like grain, oil seeds, spices and pulses, which are sub-classification under agricultural commodity which is there. Then you can have metal and minerals. You can have metals which are base metals which go into manufacturing in many other products as capital goods such as aluminium, copper, nickel, zinc, tin. All these are all base metals. Or you can also have bulk commodities which can be there, which are used in heavy industries. You talk about, you talk about steel, steel, iron ore which can be there, which is used, coal also as a part of your bulk commodities, and you have other commodities which can be there in the form of rare earth metals, or you can have chemicals which can be taken from the earth's crust which are there. Similarly, metals, you have precious also. You talk about bullion, which we say in the terms of investment. We say investment in bullion, which can be in the form of gold, silver or platinum. These are precious metals which are also a type of commodity. Or you can have commodity in the form of energy, where we have oil, natural gases, crude oil, thermal energy, coal energy, all these will be form of your energy in which investment also takes place. Then you have other services in the form of oil services, mining services and any other service which are related to these commodities which are there. So, that way you have these various classification and the sub-classification of commodities, where the securities are being traded based on these commodities in the commodity market which is there. Now, this is what is a commodity and a commodity market, but how can we trace back the growth and the evolution of this commodity market? The concept of commodity market is not new to the world. We can trace it back to 4500 BC, where today we talk it as Iraq, which is one of the Gulf regions. Earlier we used to call the tribes who used to live in that area as Sumerians. So, these Sumerians used to actually trade in commodities by using something called as a clay token. So, they would make tokens with the help of clay, and those clay tokens were used for exchange of commodities during that period, 4000 to 4500 BC, where today we call it as the region of Iraq. At that time, Sumerians used to live there, and they started trading in commodities by using clay tokens. This was, when civilizations were actually taking place. But when the world was actually formed and all, the first commodity market, we can trace it back to Osaka in Japan in the year 1730, where you had the futures trading which took place based on commodities. Similarly, in 1848, we had the Chicago Board of Trade in United States, and London Metal Exchange, which was there in London, that is in United Kingdom. So, 1848 and 1877 in USA and in UK also commodities market started to begin. In India, if you trace the history to the commodities market, this was there before independence. So, we had something called as Bombay Cotton Trade Association, cotton being an agricultural commodity. This association took cotton as a base commodity in order to do trading in securities. So, therefore, in 1875, Bombay Cotton Trade Association started trading in commodities. Same way in 1919 in Calcutta, we had raw jute and jute goods trading which took place, where we had the East India Jute Association. They started trading in jute and raw jute in 1919, and they continued up till 1927. So, the concept of commodity market and commodity trading is not something new to the world. This has been in existence since a very long time, tracing back the history from Sumerians to Chicago Board of Trade and London Metal Exchange, and then Bombay Cotton Association and Jute and Raw Jute Cotton Association. All these associations have been there throughout the world and in India, which started doing commodity trading which is there. Now, in a stock market, if you are buying and selling securities, you basically have trading of securities which take place. But in a commodities market, when you have buying and selling of these commodities, the various types of contracts through which you can buy and sell, they can be divided into three categories. You have something called as a spot contract, a forward contract, a futures contract, and attached to the futures contract, you also have option. Basic three are spot, forward and future. In a spot market, what happens is the contract takes place immediately and instantly between the buyer and the seller. For example, I am buyer and there is a seller X. Then the trade which takes place between me and between that seller X related to a particular commodity is done instantly. Then that is called as a spot market, where buying and selling between the sellers takes place immediately and instantly. The very word spot meaning that it happens immediately. Then that is called as a spot market. Then in case you have some contracts wherein the buyer and the seller are entering into an agreement today at a price which they are determining today, but the contract is to be executed in future. For example, if I am entering into an agreement with a refiner of gold, I am a buyer of gold and there is a seller of gold. So therefore, when the seller of gold is entering into an agreement with me where I am buying the gold, then in that particular case, if I am entering into an agreement today, but that agreement price is also determined today, but I am going to buy gold maybe next month, then that next month when the contract is going to be executed, such an arrangement where the buyer and the seller are agreeing for a contract today, the price is also determined today, but the contract is going to be executed at a future date, then such a contract is called as a forward contract, where the contract is taken forward at a future date. Contract entered today, price is also determined today, but contract will be executed at a future date. This is called as a forward contract. But the problem with a forward contract is, because price is already agreed today, what if any one party makes a default depending on price not being favorable to them? For example, as I said, if I am buying gold from a refiner of gold. So from a refinery, I am a buyer of gold. Now today if the price is determined, for example, today in a retail market, gold is traded 24 carat and 22 carat. Based on that, we have rates as 93,000 or 87,000 there. Now, if I am trading in 24 carat and if I am determining the price as 93,000 and I want to buy, for example, 1 kg gold, then today I am entering into a contract, but I am entering into a contract to buy gold in the next month. What if in the next month the price reaches 1 lakh? Then in that particular case, the seller wants to sell, but I may not be willing to buy. So what happens? There is a default in this particular forward contract because the price is not favorable to me. So there is always a default risk in a forward contract because the price at the date of execution of the contract may not be suitable to any one of the party, either the buyer or the seller. In such situations, what happens is exchange market will enter into picture, where the exchange market or a commodity exchange will design the terms of a contract and the contract is being executed between the parties. Such a contract where the commodity market or the commodity exchange like NCDEX or MCX, these are all exchanges which are there for the commodities market. When these exchanges are determining the terms of a contract, then such a contract will be called as a future contract, so that any kind of a default risk which can be there because price is not favorable to any one party, that's why there is a default in the forward contract. Exchange enters into picture here and they will determine the terms of contract. So then such a contract will be called as a futures contract. So in case the contract is something which is happening instantly, immediately, it is called as a spot market. If the contract is happening at a future date, price agreed today, contract entered today, it is called as a forward contract. On account of a default risk, if the commodity exchange takes care of the contract, then it is called as a futures contract which is there. So that way you have a spot contract, spot market, forward contract and futures contract which is there in the commodities market which is there. And this commodities market in India, there is a big timeline because in the Chicago Board of Trade and all, they were all established earlier, but in India the regularization of the commodities market that took place a decade afterwards, after the Chicago Board and the London Metal Exchange came. 1 decade after that, in India commodities market started to pick up in the early 1900, where you have SEBI which was there and Ministry of Corporate Affairs which is there. All these bodies started recognizing commodities market. So we had in the year 1952 something called as a Forward Contract Regulatory Authority, FCRA. FCRA was being enacted in the year 1952. Similarly, Forward Market Commission came into picture as a regulatory body in the year 1952, and then anyway you had the central government which was the governing body for all these institutions, that is FCRA and FMC. FCRA is Forward Contract Regulatory Authority and FMC is Forward Market Commission. This regulatory authority and commission, they were the bodies which were taking care of all the commodity contracts which were there in the Indian capital markets which are there. And in 2003 to 2005, Government of India also gave a permission for future trading in the commodities exchange which is there, and in 2017 SEBI automatically passed even option trading which is there in the commodities market which is there, and FMC and SEBI got merged in the year 2015. So now onwards you have SEBI only which is actually taking care of commodities market. So the regulatory bodies which you have in India throughout the timeline, if you see from the establishment or from the independence of India, you had FCRA, Forward Contract Regulatory Authority, Forward Market Commission, and today you have SEBI which is taking care of the commodities market in India. And if you see the structure which is related to the commodity market, you basically have the Ministry of Corporate Affairs, and under the Ministry of Corporate Affairs you have the FMC which is your Forward Market Commission. Under the Forward Market Commission you have the commodity exchanges, and commodity exchanges again are divided into two, national exchange and regional exchange. At the national level you have got National Commodity Derivative Exchange which is called NCDEX, Multi Commodity Exchange MCX, then you have Metropolitan Exchange, and then you have got regional, 20 other regional exchanges which are there in India. So you have Ministry of Corporate Affairs, FMC, commodity market, national exchanges and regional exchanges as a structure of the commodity market. Let us see all these markets one by one, that is National Commodity Exchange. You also have something called as ACE Derivative Exchange, Universal Commodity Exchange, National Multi Commodity Exchange, Indian Commodity Exchange, and National Commodity and Derivative Exchange of India. Altogether 6 major commodity exchanges are there in India. Out of all these, 2 prominent exchanges are there, that is MCX and NCDEX. MCX is Multi Commodity Exchange. Multi Commodity Exchange actually is the largest traded exchange which is there on bullion and crude oil. So gold, silver, platinum and crude oil. For these 4 commodities to be highly traded, you have the Multi Commodity Exchange which is available in India. This exchange has got a state-of-art electric commodity futures exchange. It offers more than 40 commodities across all categories which are there, but 4 are highest traded, that is bullion and crude oil. And in the global terms also, it is one of the 6th largest in the number of contracts which actually happen, that is Multi Commodity Exchange. Then you have National Commodity Derivative Exchange, which is also one of the largest exchanges which is related to agricultural commodity. Multi Commodity Exchange is for bullion and crude oil, whereas NCDEX, National Commodity Derivative Exchange, is for agricultural commodities which is there. And agricultural, more than 34 commodities are actually traded on NCDEX, and it is 2nd largest in India and 32nd largest in the world. So these 2 are the major exchanges which are related to the commodity exchange, which is MCX and NCDEX. Now as an investor, if I want to invest in the commodities, what all areas or avenues do I have? What all options do I have to invest in the commodities as such? First option which is available to me is a physical commodity. As an investor, I can buy physical commodity, for example gold or any other precious metal. I can buy and keep it with me and sell it in a future date at a profit. But the biggest problem with this physical commodity is the logistics and the expensive insurance, which is actually, it will eat away all the profits that you are actually thinking of generating in future. That is the biggest problem with a physical commodity which you have got. Second option that you have in commodity is something called as a commodity ETF. ETF is an exchange traded fund. The value of the fund will be derived from the value of the commodity. So instead of investing in the physical commodity, I am actually investing in the fund. For example, instead of investing in gold, I may buy a sovereign gold bond of the government. So that sovereign gold bond becomes an exchange fund which is whose base is in the base of gold. So instead of investing in physical commodity gold, I am actually buying a sovereign gold bond which is there. So commodity exchange traded funds, where you have a hassle free investment. Instead of holding a physical commodity, you are actually holding an exchange traded fund which is backed by the value of the commodity. Similarly, you can also invest in something called as commodity mutual funds, where these are mutual funds which are actually owned by some companies, and these companies, we as investors, we can invest in these mutual funds. And because there is whole lot of diversification which happens, many people are investing in the mutual fund. Because of the advantage of diversification, these companies in turn, they will invest in the commodity ETF. So as an individual investor, I invest with a mutual fund company. That particular mutual fund company will invest in the commodity ETF. So what is happening here? I am not investing directly, but I am investing in a mutual fund, and the mutual fund is investing in the ETF. So such an arrangement is called as investing through the commodity mutual funds which are there. Same way, I can also invest in something called as commodity option. Commodity options are better than futures because here the buyer has a right but not an obligation to buy or sell the underlying commodity in the future at a particular price which is struck today. Mostly MCX, which is the multi commodity exchange, they offer option contracts so that you can do dealing in gold, silver, crude oil, zinc, or NCDX also offer commodity options where you can have trade which takes place in soya bean, refined oil, seeds, chana dal, etc. All these options also you can invest in. You can also do investment in futures, which is where commodity futures come into picture. So instead, a contract between two parties where you are buying and selling the underlying commodity at a fixed price today, but the contract is going to be executed in the future. So commodity futures, you can have future trading in petroleum, gold, silver, natural gas, wheat, cotton, all these commodities you can do investment. So when you are talking about investing in commodities, you can buy a physical commodity, you can invest in ETF, you can invest in mutual funds, commodity mutual funds, you can invest in commodity option, or you can invest in commodity futures. All these are all avenues whereby you can make investment. 5 avenues: physical commodity, ETFs, commodity mutual fund, commodity options, and commodity futures. These are 5 options through which you can make investment in the commodities. Now when you talk about commodity trading, most people say that why should I prefer commodity trading over equity trading? So what is the advantage that I derive by investing in commodities market? Basic advantage is there is a lot of protection against inflation which is there, and whole lot of transparency because all transactions happen on any exchange which is there, and you can also protect yourself against major geopolitical events which may happen like a war or any treaties which are signed between the countries and all. You can have protection from all the potential dangers from the geopolitical events which can be there. But at the same time, there are also disadvantages because the market is highly volatile, because you are talking about commodities and demand and supply of the commodities plays a role. Especially if it is agricultural commodity, you have the natural factors like rainfall, monsoon and all, which plays an important role there, and diversification always does not give you protection. So the risk may be diversified as such, but risk basically cannot be eliminated if you do in commodity trading. So there are also merits and demerits when you talk about commodity trading. Now as an investor, when I want to invest in commodity trading, what should I do? Basically, first you have to open a trading account. Trading account should be opened. Then you have to find a brokerage firm which will actually do buying and selling on your behalf. You have to understand what is the demand and supply factors which are there, seasonal patterns, global influences on the price, all these you have to take into consideration. Whatever is the required amount required for trading, you have to deposit that amount in the trading account. And also the brokerage fee which is available, that also you have to deposit in the trading account. Then you have to choose the commodity. In whichever commodity you want to invest, you have to choose the commodity based on your trading plan. You have to market whatever is the trends which are happening in the market, make a record of all the trades which are happening, entry, exit prices, trade volume, results which are there, and continuously stay updated about the commodity market which is there, stay informed about the developments and the news which is happening around the commodity prices. So that way it becomes very easy for you to trade in commodities. There are various strategies of trading in commodities. Firstly, you can do something called as trend following. In trend following, what happens is you analyze the historical data. What is the historical data? How is the commodity growing or coming down, uptrend or downtrend? You can follow the trend and decide. Or you can do something called as range trading, where you talk about commodity prices which fall within a range, and as a trader, whenever it reaches the bottom you buy, and whenever it reaches the top you start selling. Or you can also do breakout trading, where whatever is the resistance level, if it is coming close to the resistance level you buy, if it is coming falling below the support level you sell. You can do breakout trading. Or you can also do something called as fundamental analysis, technical analysis, seasonal trading, where you talk about various broader factors, macroeconomic conditions like economic factors, weather conditions, geopolitical factors, government policies. All these play an important role in determining fundamental analysis. Or you can also do historical price data related to your stock trading, and then you can do your trading decisions, or even patterns related to specific times during the year. So, seasonal trading strategies also can be taken into consideration, especially applicable for agricultural products. So, therefore, these are the various strategies which are available for commodity trading. As an investor in India, if you are thinking about investing in commodities market, the best options that you have is in the form of metal. You can invest in bullion, that is gold or silver, or you can invest in energy resources like oil and other base metals like aluminum and copper, because they have got their respective advantages which are there. So, in today's session we have discussed about what is a commodities market, where as an investor, if I do not want to buy the shares of a company, where else can I invest? So, you can invest in commodities market, which is also a regulated market, regulated by Securities and Exchange Board of India, Forward Market Commission, Ministry of Corporate Affairs, where trading takes place in commodities which can either be hard commodities like metals, energy, oil, or it can be soft commodities like agricultural commodities which are there. So, as an investor, I am not investing in the equity of a company, but I am investing in commodities and trading in commodities. So, this is about commodities market in India. Thank you.